I'm Doug Goldstein. This show is about taking care of your money now so that your money will take care of you in the future. We've got investment profiles, tips of the week, financial strategies, and best of all, we've got fabulous guests. I hope you'll enjoy today's guest on the Goldstein on Gelt show.
You're listening to international investment advisor Doug Goldstein on the Goldstein on Gelt show, the financial show where we'll talk about how you can make the most of your money. With all the confusing financial chatter bombarding you each and every day, Goldstein on Gelt will give you the practical information you want and need about living a financially stable life. Here's your host, money maven Doug Goldstein.
Okay, we are back. We are talking with Joel Greenblatt, who is the founder and managing partner of Gotham Capital. He is an adjunct professor at Columbia University Business School. He started as a pure value investor and then was influenced by, Warren Buffett and other great investors. He's a New York Times best-selling author, his newest book being The Big Secret for the Small Investor, which talks about a new route to long-term investment success. Joel, it's a pleasure to have you here.
Happy to be here. Thank you for asking me.
Listen, your book, The Big Secret for the Small Investor, I don't know if we can ask you this, but could you tell us part of that secret?
I'll give you the whole secret, although there are a few other things in the book, hopefully. The big picture is that the world has become much more institutionalized over the last 30, 40 years, which means institutions have to perform each year or they lose their customers. And so most managers, investment managers, respond by looking at the short term, meaning, trying to find things that will do well in the next year or two. And it leaves a whole bunch of opportunity for people who are willing to take a longer term horizon with their investments and look past the next few years when they look at things to buy. So if there's a company that might not be doing as well in the next year or two as it did last year, or there's some uncertainty involved, there's a big opportunity to look at those on a value basis and buy them as long as you're willing to be patient. And most professional managers just can't be patient because their clients aren't.
So that's exactly my experience with clients. We talk to them about being long-term investors, and sometimes they'll say, okay, is 90 days long enough? Is there a way that
I think you have to have at least 4 months. No, I would say 4 or 5 years is really the horizon that I'm talking about.
So what happened after, in 2007, 2008, when the market had hit such a low that it had a negative 10-year track record on the S&P 500, and people said, I was a long investor. See, I waited 10 years, and I'm in the hole. What would be the response to that?
Right. Well, one of the things I talk about in the book is I'm actually a value investor, and in simplest form, what a value investor would try to do is figure out what something's worth and pay a lot less. That's what I call value investing. Mm-hmm. And if you did follow the strategy that I recommend in the book, which is continually rebalancing, making sure your portfolio is stocked with companies that earn a lot of money, but that you don't have to pay a lot for those earnings, yet at the same time they're earning high returns on capital, which I talked about in my previous book also, which just means they're very good at putting the money to work in the business whenever they do invest in their business. If you have those two things, one was Ben Graham, buy something cheap. The other was Warren Buffett, which was, Warren Buffett was a student of Ben Graham's and said, well, it's nice to buy cheap, but if I can buy good business cheap, that's even better. So sort of combine those two concepts into good and cheap companies. And if you followed that, you would have made quite a bit of money. You would have made about 10 or 12% a year during the period where the market wasn't up at all. And that's just constantly rebalancing towards those cheapest companies. So the fact that the market didn't go up over 10 years doesn't mean that it didn't bounce around an awful lot during that time. And their markets are quite emotional over the short term, and there's plenty of opportunity to if you have a disciplined approach to take advantage of that.
So this disciplined approach is as opposed to something which would be more opportunistic, right? Today people say, well, what about gold? It seems the world is falling apart. Do you hold by buying things other than stocks?
My expertise is in the area of stocks, and so what we designed is actually a set of, some smarter indexes. In other words, most people are familiar with the S&P 500 or the Russell 1000. These are just standard indexes of a large amount of stocks, but they're weighted by their market capitalization, meaning the larger the company is, the larger the weight the stock has in its index. So that the S&P 500, for instance, which is the index that most people benchmark their returns against, actually the top 20 names out of those 500 names in that index account for about 33% of the index. So it's not even that widely diversified. And then it's also really actually not a great way to invest, because what I believe, and I think Ben Graham and Warren Buffett's of the world would also agree with this, is that, and I think just observing and reading the paper and watching what goes on, whether you're talking about an internet bubble or a bond bubble or whatever it is that markets over the short term can be very emotional. And if that's true, some stocks at times are overpriced and some stocks are underpriced. And so what a market cap weighted index like the S&P 500 does is anytime a stock is overpriced, it'll buy too much of it, because it's measuring how much it should buy by market price. The higher, the more it buys. So if a stock is overpriced, you automatically buy too much of it in a market cap weighted index. And if a stock is a bargain, it's priced low, and the index automatically buys too little of it. And in that way, it costs you about 2% a year.
Wow. We're talking to Joel Greenblatt, who is the managing partner of Gotham Capital, a hedge fund based out of New York. He's also a teacher at Columbia University's Business School. He's a New York Times bestselling author, and he's written a number of books about investing. You've spoken about rebalancing and owning a lot of stocks. Do you think this applies for investors of all ages? For example, someone who's owned stocks now is retiring. Is this still appropriate for him?
Well, what I was talking about is sort of a different, a smarter type of index approach is what I talked about in the new book. Meaning, there are all kinds of indexes. So the one I talked about already was sort of market cap weighted. And so basically in the book, I discussed how we came up with what we call the value weighted index, which basically just puts more value in the cheaper stocks. So we sort of do it for you. And we actually created some mutual funds that are, effectively index-like in the fact that they have 800 to 1,000 stocks and are very diversified. And we're just trying to take advantage of this phenomenon. But like anything else, every strategy that differs from a standard index will have times where it outperforms and underperforms. And the key to sticking with something that's underperforming is to understand what you're doing. And so I've spent a lot of time, writing books and trying to explain the philosophy behind what we're doing and the logic behind it, so that when things don't go well, people don't give up on that strategy because they think it makes sense, and that over the long term, even though over the short term, it may not. I'll give you a couple statistics that I think are pretty interesting. I wrote some of these up in the book. One of which is that if you look at the top managers over the last 10 years, the top mutual fund managers, and you look at the top quartile, that means the best 25% over the last 10 years, meaning those are the 25% that ended up with the best record over a 10-year period. 97% of those guys spent at least 3 years in the bottom half of performance. 79% of the top performers spent at least 3 years in the bottom quartile, the bottom 25% of performance, and approximately half of those top managers, after 10 years, 47% of them, they spent at least 3 years in the bottom 10%. So you know what would happen to most of those managers who ended up with the best long-term record? People would run from them because they had long periods of underperformance. And I think that's the problem for individuals. The other problem for individuals is that, they don't know what logic goes into managers' picks. So all they see is the performance data. So they can look back over the last 3, 5, or 10 years of performance of a mutual fund manager, and that's how they usually pick their mutual funds. Unfortunately, there's no correlation between how a manager did in the last 3, 5, or 10 years and how they're going to do in the next 3, 5, and 10 years. So people are kind of lost.
Aren't they going to end up looking at the ratios like the beta, which looks at the volatility compared to the rest of the market, or they'll look at the alpha, which shows the value that the manager added? And they'll find a few numbers that just seem to make sense and put that aside.
There's another fancy Yeah, I sorry to interrupt you, but alpha is just another fancy name for who outperformed. Okay, and looking at that number doesn't help you predict who will outperform. It just looks at the past.
So you're saying that unlike horse racing, where you would want to buy the horse that tends to win most of the time, or over the past couple of years has won more races, it doesn't really matter with mutual fund managers?
Well, that's just what the facts say. There's just very little else for people to look at. If you were really evaluating people, you would have to evaluate their process, and then you would determine how much was luck and how much was skill. But it's almost impossible to do that with managers. So, and 70% of them underperform the market averages over long periods of time. So what that means is that that's why most advisors recommend index funds, because 70% of active managers underperform, and there are no reliable ways to find that other 30%. It's almost as hard. Like, you might as well pick stocks yourself. So it's just as difficult a challenge as to pick managers that will be future winners. So.
All right, that puts us in a little bit of a bind. We've been talking to Joel Greenblatt, who is the managing partner of Gotham Capital, a New York-based hedge fund. He's also written a number of books about investing that are designed for regular investors. Joel, we only have a minute or two left, but I just want to focus. Not only are you a Wall Street player, but you're very involved in philanthropy. Specifically, you focused on setting up schools to help underprivileged kids succeed. Could you just give us a little thought about where you see that going?
Sure. Well, I know Israel has their challenges as, in public education, and the U.S. does also. And it's a very uneven system where some schools are good and some schools aren't. Unfortunately, in the poor neighborhoods, they're generally the ones that get the worst schools and less funding and everything else. And wealthy parents can move and go into a good school district the way it works in the U.S. or pay for private school. Poor parents don't have that option. So to give them an option, there's a movement to set up charter schools. These are schools that are set up under different administration and rules than the regular public schools. Traditionally, they're not unionized, and they're not subject to a lot of different constraints that the regular public schools. And the hope there is to create models that work better for these underprivileged kids. And, my day job, I'm a capitalist, and I believe strongly in that system, but it only works if everyone has a fair chance. So, I thought that starting in education at young ages was really the way to equalize the system. And so it's been a fun project, and so far so good.
Okay, I wish you luck on all of that. Joel Greenblatt, in the last few seconds then, could you tell how we could follow the work that you're doing?
Sure. I think the best way to do it is go take a look at valueweightedindex.com, and I explain the value index that we set up that, we studied over the last 20 years and has beaten the S&P 500 by about 7% a year during that time. So it's valueweightedindex.com. And you could read both of my books, which are, I've written 3, but the 2 that I think would be most helpful to people is The Little Book That Beats the Market, which I wrote about 5 or 6 years ago and updated last year, and The Big Secret for the Small Investor.
That sounds great. Joel Greenblatt, thanks very much for your time.
My pleasure.
You've been listening to the Goldstein on Gelt Show with money maven Doug Goldstein. Doug's weekly radio show is heard around the world, but if you miss it, you can download the podcast at www.goldsteinongelt.com. The Goldstein on Gelt Show gives you up-to-date financial ideas so you can get on the path to financial freedom. If you'd like your questions answered on the air or off, send Doug an email to doug@profile-financial.com. It's your money for your future, so join Doug every week to build your wealth on the Goldstein on Gelt Show.